Hey everyone, welcome back to our On the Money YouTube channel powered by Allied Wealth. Matt Stevenson here. And today what I wanted to address is a very important topic when we look to build financial plans for our clients, how we go about building a smart plan to help them navigate the course of their retirement years. When we define building a smart plan with our clients' investments, we want to seek adding value to their lifestyle over the course of their 20 to 30-year retirement to ensure that they don't run out of money or income in their golden years. And when we define building a smart plan, this is going to involve investments where we take what we call a smart risk approach. And so oftentimes here, we're considering a tactical approach to how we invest. Many of us saving into our IRAs, 401ks, maybe we have more of a passive or a buy and hold type of approach. And that can be good when the market is soaring along and having those awesome years. But when we have a lot of risk in the market and when we get into retirement, we need that consistency. We're seeking to minimize the risk that we take with our money and the potential for loss to get a tighter range of expectations and know better what the outcomes should be over the course of our retirement. That's what we mean by taking smart risk with our money. But we want to balance that equation out. We also want to consider investments that are what we call smart, safe investments. These are investments that look to protect a part of the nest egg, still get good growth over time, and provide us access to dollars in a cost-effective way over the course of our 20 to 30-year retirement. And it's finding the right balance between investments that offer smart risk and smart safety that makes all the difference. When we think about adding value to our clients, that comes in several ways. The first thing that I consider is what would it cost our clients to actually work with us? So here's an easy math example. So let's say that I've got a client that has $500,000 on the smart risk side of the board. So let's say that in this example, our annual cost to work with that client is 1.5% per year. Well, that means that over the course of that year, that client would pay $7,500 in fee to that advisor. We combine that with the smart safe, the protection side of the board, where oftentimes we're looking for programs that have no annual cost at all. And so there, the client pays zero in that year. And so effectively, we're able to help them with $1 million nest egg for 0.75% per year. Now that tends to be quite cost effective. The next thing that we want to consider is liquidity. And that's a fancy way of saying, how do we access dollars in retirement? Because we absolutely will need to access these dollars for monthly, annual income, maybe emergencies that can and will pop up along the way, travel, spending time with friends and family, all the things that are going to add value to your lifestyle in retirement. And when we consider liquidity, we want our investments on the smart risk side of the board to be 100% liquid at all times, meaning if we wanted to withdraw every dollar on the smart risk side of the board, we could have access to those dollars. Now, should we do that is a different conversation that we need to have. Certainly there's tax implications involved there, and we want to make these dollars, again, last your lifetime. But in that example, we have access to those dollars anytime we need it. Now, on the smart safe side of the board, in order to get the benefits of protection that these programs provide you, they do offer you some access to dollars each and every year throughout retirement. And often that's to the tune of 10% of the account balance each and every year for monthly income, travel, spending time with the family, you name it, whatever your needs are. So in that example, we have $50,000 of access to the safe side of the equation anytime we need it, every single year. And combining both sides of the board, that gives us $550,000 of access to your life savings anytime that we need it. Now the question we have to ask ourselves there is, how do we know if that's enough liquidity in retirement? Well, ask yourselves the question listening at home. When's the last time that you wrote a $550,000 check? Maybe you have, maybe buying or selling a home. And if you haven't, that's perfectly fine, right? But that also likely tells us that there's plenty of liquidity and access to your dollars every single year in retirement. Now, last but certainly not least, and one of the main reasons why we build plans in this way and the ways in which we add value to our clients' financial lives is how do we mitigate the chances of a major market crash impacting your nest egg in the years that matter most. So in this example, working with this client, they had $1 million more or less in that passive kind of buy and hold type of strategy, if you will, mostly tracking our stock market. And in that example, we were able to quantify that they stood the capacity or the risk of loss of about 30% if we had a major market downturn, similar to a 2008-2009 scenario. And there, $1 million nest egg at a 30% drawdown or loss turns into $700,000 in the blink of an eye. Now that's where we might have to consider a lifestyle change. Maybe we defer retirement an extra year or two. Even worse, maybe we retire and have to go back to work if we see that sort of loss impact our financial future. And that ties back to how do we build that SMART plan to mitigate the chances of that from ever happening. And so there we have our investment on the SMART risk side of the board at $500,000. Let's say that we're able to build a plan to where we're able to and seeking to limit the loss to about 10%, even in those impact years for the market. There, we would have a $500,000 nest egg that drops 10% to $450,000. Lest we not forget the safe side of the equation. And that's exactly why we use these programs. Yes, to get good growth, but also to protect us in the event of major market downturns. There we have our $500,000 investment, and in those years, we are protected. We have no drawdown or loss. We still have our $500,000 portion of the nest egg there. Combining the SMART risk and the SMART safe side of the equation, even in a 30% market downturn, where this client would have lost $300,000 of their life savings, here we went from $1 million to $950,000. And ask yourselves the question at home. If we went from $1 million nest egg in one of the worst market downturns we've ever seen down to about $950,000, would that cause you to consider a lifestyle change? Likely not, all right? And so this is exactly what we're seeking to do in minimizing the chances that our nest egg is impacted by a market crash. The main goal, in fact, there is to take a lifestyle change off the table as much as we can over the next 20 to 30 years. And talking about adding value to our client's lifestyle, that is what we call return on investment. If we're able to build a plan for you to save you $250,000 in a major market crash, that is one of the biggest return on investments and value adds that we can seek to offer for you. Folks, if you have a question on how to build your SMART plan, simply give us a call. It's 281-444-7555. And as always, hit the like button, subscribe to the channel for more content, and I'll catch you next time.